Hello, Dr. Chatterjee. Today I will be presenting to you my corporate finance report as well as an overview of all the financials associated with it. This will be a corporate analysis comparison, financial analysis comparison, computation of capital, and a historical analysis of company stock between two of the largest publicly traded electric providers in Houston and in the world. Energy Incorporated being a power industry leader, and CenterPoint Energy Incorporated being a natural gas maverick of the industry. I will now give you a little background analysis of both of my chosen companies. Energy Incorporated. Energy is the power industry's leading company and has grown from a power generator into an energy provider that provides homes and businesses throughout America with electricity and power. Their customer-focused mentality has led them to create technologies and tools that empower residents and organizations to think critically about their electricity, including where their power is coming from, what impact it has on the environment, and how they can become more conscious energy users. Energy partners with businesses to customize innovation power and sustainability solutions that are informed by years of experience as market leaders. Energy works diligently to stay ahead of an ever-evolving energy climate with rising demands. Their competitor, CenterPoint Energy. CenterPoint Energy's vision is to lead the nation in delivering energy, service, and value drives their strategy and performance. CNP has an unwavering commitment to safely and reliably deliver electricity and natural gas to millions of people. CNP sells and delivers natural gas to more than 4.5 million homes and businesses, to be exact, and this is in 8 states, including Texas. CNP is investing in modernizing their natural gas infrastructure and are committed to eliminating cast iron pipes in our territories because they've proven to cause difficulties with the environment. After a brief analysis of the board of directors and management, it has been determined that the board of directors and management of Energy tend to make more money than those at CenterPoint Energy. With that being stated, I will now go into the comprehensive financial analysis section of my report, and I will use my Excel sheet as a guide. I have extracted the company data for both companies, and I have completed the financial analysis. I will start with the liquidity ratios. The liquidity ratios are current ratio and a quick ratio. The liquidity ratios measure the relationship measures between current assets and current liabilities. The current ratio is current assets divided by current liabilities. For Energy, the ratio declined from 1.77 in year 2014 to 1.50 in year 2018. While for CNP, the ratio was 0.9 in 2014. It fluctuated between 2015 and 16 and then progressively increased in years 2017 and 2018. The quick ratio measures current assets less inventory divided by current liabilities, which I have here. The essence of the liquidity ratios is to measure the ability of the two companies to come up with the payment to short-term creditors. Next, I will focus on the efficiency ratios. These ratios include the average collection period, accounts receivable turnover, inventory turnover, average age of inventory, inventory to net working capital, total asset turnover, fixed asset turnover, fixed charge coverage, and basic earnings power. The efficiency ratios measure how efficiently an organization is using its assets to generate revenues. In other words, how efficient is an organization in using its assets to generate revenues? Looking at the total asset turnover ratio for NRG, the ratio progressively moved from 0.39 in 2014 to 0.89 in 2018. This is an improvement. The total asset turnover for CNP did not significantly fluctuate. It hovers between 0.397 in 2014 and 0.39 in 2018. Accounts receivable turnover for both companies are within the industry quartiles. Money was left in the hands of debtors for approximately between 8 days to 12 days, which is not a long amount of time at all. It's pretty good. Next, I will go into the profitability ratios of the company. The profitability ratios include the debt ratio, debt to equity ratio, long-term to debt equity, time interest earned, total profit margin, operating profit margin, net profit margin, return on investment, return on asset, and return on equity. The profitability ratios measure how profitable an organization is. Is the organization reporting profit or loss in each accounting year? The ratios talk about the relationship between profitability and total revenue. The total profit margin measures the total revenue less cost of goods sold divided by total revenue. The gross profit margin for NRG did not significantly change within the 5 years under consideration for the project. The gross profit margin was 26% in 2014, and it was 25% in 2018 for CNP. For CNP, the gross profit margin declined from 10% in 2014 to 8% in 2018. The net profit margin is net income divided by total revenue. For NRG, the net profit margin was 0.08% in 2014, and it continues to grow to become 2.8% by 2018. This is an improvement. The net profit margin of CNP actually declined from 6% in 2014 to 3.4% in 2018. This is bad. Decline in profitability is not a good signal to corporate growth. Next, I will go into the market value ratios of my project. These include earnings per share, price earnings, market price of shares, book value per share, market value to book value, cash flow per share, dividend payout, dividend yield ratios, dividend growth rates, rate retention, and the dividend per share. The market value ratios measure how reasonable the market price of the stock of an organization is in relation to the earnings of such an organization and its growth. The PE ratio is the ratio that measures how long it will take for an investor who holds 1 unit of NRG share to recoup its investment. The PE ratio is the market price of shares divided by earnings per share. The cash flow per share is net income plus depreciation divided by the number of shares outstanding. It shows how much cash flow each unit of shares held by an investor generates. This ratio declined for both Energy Incorporated and CenterPoint Energy Incorporated. go over the accounting measures. The ratios covered under the accounting measures section are net operating working capital, total net operating capital, tax rate, net operating profit after taxes, free cash flow, return on investment capital, operating cash flow, market value, book value, and market value added. The accounting measures look into what value does the company generate for investors in a particular year. These measures, as seen on my Excel spread, these measures look at net operating profit after tax, no parts, free cash flow, net operating working capital, etc. In all, most of these measures confirm that both Energy Incorporated and CenterPoint Energy Incorporated returns value to their investors, which is a good thing. Next, I will go into the computation of capital section of my report. In the computation of capital section, I did the ratios for after-tax cost of debt, cost of preferred stock, cost of internal equity, cost of external equity, weighted average cost of capital, capital structure, and individual capital costs for both of the companies. And these were my findings. The cost of capital is completed by adding together the cost of individual capital, providing in the capital structure of the company after multiplying them by the weight of each capital. The addition will give us the weighted average cost of capital for the two companies, which has been provided. This brings me to my next section of my report, which is the historical analysis of stock prices. To give you an overall view of how the data looks on a graph, please note this graphical representation for energy for the past 2 years of their historical share price. Please note that there is an upward trend. Next, I will show you the results for CenterPoint Energy. As you can see, the analysis shows that it's not going in a downward trend, but it isn't going up as high as their competitor, NRG. But the good thing is, so far, the prices of their stocks have not gone down consistently. Of their share prices have not gone down consistently. The next graph is a historical stock price of Dow Jones Industrial Average for 2 years. This was used in tangent with the other graph to get a determination of what's really going on with the two companies against market standards. And this is what this graph provided. Now, I will give you a historical analysis of stock prices, my conclusion of it. So in conclusion, the historical stock price looks at the relationship between the prices of the stocks of energy and that of the market for a period of 2 years. This is equally done for CenterPoint. The market considered in this case is the Dow Jones Industrial Average. A regression analysis was also done to evaluate the slope of the prices with that of the market, as explained before. The slope of these two companies' stock prices show a positive trend. Energy better than CenterPoint Energy. So what does all of this mean? What did I conclude from these calculations and the data and research put into this project? In conclusion, Energy Incorporated, as well as Centerpoint Energy Incorporated, have good shows in most of their measures. They return value to investors, which is ideally what everyone is going for. However, it is important for them to improve on their profitability, both companies, as well as improve on the use of assets, and also to improve on their solvency, which is how they pay back loans and interest. Thank you, sir, for taking the time to listen to my report. This concludes my presentation of my corporate financial report. Thank you.